Hello, class, and welcome to our sixth lecture series on principles of accounting or financial accounting. And I'm your instructor, Dr. Jamal. Okay, so in our last lecture, we were talking about the accrual accounting in comparison of with cash accounting. And then we talk about, you know, different stuff, account adjustments. We talk about that after making trial balance, we still have to make the entries. And what are those entries? Like accrued expenses, prepaid expenses. So we finish our discussion here on accrued revenue. So let's just repeat that. Accrued revenue means revenue occurred, which means revenue or sale occurred. You did not collect the cash. So for that one, you create account receivable. We also did this example here. So let me just read that for you. Assume that FedEx hired Friday on 15th of June. FedEx will pay Friday 600 monthly with first installment on 15th of July. So during the Friday, let me replace the controls here. Okay, during June, Fridays will earn half of a month's fee for the work done on 15th of June through 30th of June. So remember, they already delivered the service. Which one? Half of the contract. So their month starts from 15th June to 15th July. But Friday's business, they make monthly entries. That's it. So half of the month, which means 300, will be delivered. Services or sales occurred. But did they collect it? No. So matching principle is you need to record the sales and expenses when it happened, in which year or in what month happened or which day happened. You must record on that day, on that month, on that week, on that year. Okay. So half of the sales value we record, but did we receive cash? No. So we create account receivable or customers. So account receivable, it has a future benefit. These are our assets and what. Okay, guys, sorry about that. I think there was some glitch. Okay, now can you hear me?
Yes.
Okay, good. So customers to sales revenue. So sale gonna be in sale increase, credit. Asset increase, debit. So accounting entry would be account receivable to service revenue. And then we post it here. All right, there we go. Okay, today we'll talk about the unearned revenue. So look at the start of the concept here. Unearned, which means you're not eligible to record the revenue right now. Right? It means customer paid you in advance. Sale didn't happen yet. So it means you are liable to deliver the goods and services in future. All right? But in future, so it means you create liability. So unearned revenue is our liability. Okay? So receipt of cash before earning the revenue is recorded as liability. So remember, you receive cash in advance, but sale didn't happen yet. You cannot record the sales. So you just made an entry, cash received and liability increase, cash increase and liability increase. So the common points are customer deposits, magazine subscription, rent, airline tickets. All right. So if you are in renting services, somebody paid you in advance. So months didn't end. So rent cannot be charged as a rent service or as a rent revenue. So here we go. Please read the scenario here and make the entry. So let me read that. For those who are watching online, please pause the video and read it by yourself and try to make the entry. Here we go. So suppose Home Depot engage Friday Auto Services to perform routine oil changes on Home Depot trucks. Since this is auto services, it is their sales revenues to provide services of auto management. And Home Depot is our customer, right? And he agrees to pay 400 monthly at the beginning of the month immediately. It means oil is not yet changed, but he paid the upfront. So if Friday collects the first amount on 15th of July, what will be the entry? On 15th of June, they receive 400 against revenue? No. Revenue is not yet earned because oil of the trucks are not yet changed. So what are these? Then this is unearned revenue. This is liability that you have to perform in future some services. So entry going to be cash coming into the business, cash increase, cash is asset, asset increase, debit. Liability increase, credit. So cash to unearned liability. So if you post it, simple, make a T account. Simple. All right. Any question? Guys, I would be needing your participation here because if you don't speak, I cannot understand that whether you are good or not. Okay, good, good. So on 15th of June, what happened? The unadjusted trial balance list the unearned service revenue with 400 credit balance. If you go here, so this is 400 credit balance, right? On June 30. So during the last 15 days of the month, Friday will earn one half of the 400 that day that a customer upfronted. So it means in between the 15 days, when the closing date arrives, half of what customer paid, the equivalent amount of oil change we have already done. So we provided services. So in June, how many services are provided? How many sales? Only 200. But cash received in advance. So can we say cash to revenue? No, because cash is already recorded. So now we need to decrease the liability. Decrease in liability, credit. And sale occurred, sale increase, credit. So entry is complete. So it's going to be unearned service revenue, which means liability. Liability decrease means debit. Revenue service increase, credit. So 200 in the month of June. All right. You post it, your service revenue will be increased during the month of June. All right. And the balance remain is just 200. Any question?
No.
Good.
No.
So we have just completed the adjustment of the accounts. Here we go. So every adjustment needs two entry. For example, at first, if we talk about the prepaid categories, number one, the prepaid categories, when you prepay, it means you pay cash in advance. Business pay cash in advance, prepaid. Cash going out, so entry gonna be prepaid expense to cash. So prepaid expense is our asset, not the expense. Don't go the word expense here, go here prepaid, because its benefit is not yet being utilized. Later on, when the benefit is utilized, so we decrease this asset against our expense. So expense increase, asset decrease. All right. The second category, unearned revenue. First, you receive the cash to create liability because services and products are not delivered, cash to unearned revenue, and then when it is delivered, then unearned revenue to revenue. All right. And then we talk about accruals, accrued expenses, which means expense occurred but you didn't pay, like salaries occurred but you didn't pay yet salaries. All right. So when you didn't pay yet, it means you will pay in future, you create liability. The expense will be recorded on the day, on that day when it is done. Okay. So expense to payables. Did you pay cash? No. When you pay cash, liability decrease, cash decrease. Liability decrease, debit, cash decrease, credit. And the last one is accrued revenue. Accrued revenue, which means you sent the goods as a business, you sent the goods, but customer didn't pay you yet. When the customer didn't pay you yet, you create customers. Customer means in accounting, account receivables or just receivables. So receivable to sales or revenue. When you receive cash, simple, decrease this customers. Cash to receivable. Cash increase, receivable decrease. Cash increase, debit. This is receivable decrease, asset decrease, credit. So there are 4 kinds of adjustment, right? Let me just state here. So summary here. So the 2 purposes of adjusting process are, number 1, to measure income and to update our balance sheet. Because on balance sheet there are some prepaids, there are unearned on the liabilities, prepaids on the asset side. So we want to know that how much assets we have consumed in prepaids and how much services we have been delivered to the customers, right? So when you do this kind of stuff, our income is updated, our balance sheet is also updated, and we will be correctly measuring our monthly or yearly income. All right. Now, therefore, every adjusting entry affects both the following. And every entry, if you see here, we talked about that. Expense belong to income statement, payable belong to balance sheet. So every adjusting entry is a mix of both income statement and balance sheet. Both statements are going to be updated. Okay, so here we go. This is just for your, because if you know the logic behind that, you don't need to memorize this stuff. This is just, okay, prepaid expense, and adjusting entry going to be that asset is going to be expensed. So expense is going to be debit, asset is going to be credit, because this is our asset. Depreciation, all right, depreciation increase, expense, accumulated depreciation decrease, here, credit, right, because this is a contra account. And we talked about that. If you don't understand the depreciation stuff right now, don't worry about that. We have a separate whole chapter to discuss this. Accrued expense, this is our accrued expense liability.